Disclaimer. Trading financial instruments carries risk. This material does not contain investment advice, nor should it be viewed as a personal recommendation, or an offer of, or solicitation to trade in financial instruments. Past performance is not a guide to future results.
Hello everyone and welcome to a new ATFX video. My name is Gonzalo Canete and I'm here to give you a quick update about financial markets, equity, fixed income, commodity, forex, even cryptos. I am going to share with you what's the situation of the financial markets today, 15th of February, and considering also the whole week we have been passing through, which is Monday, Tuesday and Wednesday. Important data, especially from Federal Reserve. Well, not from Federal Reserve particularly, but the concerns about what could be the position of Federal Reserve now, considering after inflation rate published this week by United States. Let's take a look on the screens, and remember, we're gonna follow the calendar, but also I would like to highlight, as always, to you that every single detail is published here daily basis. I'm doing a report that you can access through the blog of ATFX Connect, but also you can access to that report on your newsletter. If you want to request access to the newsletter, you just need to send me an email and I'm gonna have you for free in my newsletter, so you will receive on your email every single day the last updates. This week we have seen, let's go part by part, because the last news is just the comments done by Janet Yellen, which yesterday was mainly processed by the market. It was positive and optimistic comments related with the inflation rate from United States. The data was not actually so good. It was causing, I will show you quickly, it was causing this drop on the price of the market. We are watching right now on the screen SP 500, the biggest equity index in the world, and it was dropping all the equities, mainly because the main interpretation that the market was doing of this inflation rate hike, it was basically like probably the Federal Reserve will take decisions in terms of the interest rate cuts. They maybe postpone the decision of cut interest rates. It was here, as you can see, it was the inflation, the core inflation, and also the annual inflation was 3.1%, highest than expected. It was expected to be 2.9%. Even monthly was 0.4% when it was expected to be 0.3%. So therefore, again, the conclusion after this is the inflation is not completely gone. And as many other members from Federal Reserve was mentioned before, even when the market didn't want to listen that, even when Wall Street, though, it was not interesting on this, it is that maybe it's too early to cut interest rates. Waller even mentioned 3 weeks ago the conclusion, the thoughts that he was stating, like, considering the inflation rate still far from 2% target, considering unemployment rate still below 4%, why we need to hurry with the interest rate cuts. And because of that, actually, I was mentioned this yesterday, because of that, the market is discounted interest rate cuts by 37% for May, when it was like a month ago, it was 70-80% discount, the interest rate cut. So again, translation of all of this is deception on the market, but still the market was coming back to the main levels, at least recovered part of the levels, breaking up the 5,000 points, which was the maximum new record achieved last week. And you see the market is just recovering by 5,020 points, still not on the top of the chart, which it was 566.5 on mini SP 500 future, mini futures. That's what we're watching right now. Considering this, since the inflation rate was published, the market didn't recover still the main levels. You can see similar movements on Nasdaq. You can see similar movements even on Russell 2000. The drop on Russell 2000, which is, as you know, probably represent the more realistic vision of the companies, of the businesses, macroeconomical view of the businesses in the United States, because it's composed by small and middle caps. And in this case, this index was dropping really strong compared with the rest of the index. From the European side, we also seen that drop, but still is recovering back again. And Germany, it's actually breaking up new maximums, because it's quoting about 17,000 points. It's not right now 17,056, more or less. Rising the prices again. And let's see how it's going, because if you take a look on long term on this equity index, the biggest one in Europe, you will see that actually in super long term we could see that it is not as nice as it looks, because we can see that it's facing right now top new records on this channel. If you actually check also longer historical data, you will find out that since 2009 that trend, that range, it's working, and therefore we could expect, as you can see on the chart, that maybe in the coming days or in the coming weeks a correction will start, and that correction could take weeks or months to be complete, and even retransmit the price to the levels of 15,000, even below the 50,000, even to 13,000 if you want to go to the bottom of the range. So keep an eye on European stocks. That's the most important thing. Now, again, back to the macroeconomics and data, we can see here. This is the one I was published yesterday. Let's go to the one today. But mainly Janet Yellen, the president of the Treasury of the United States, was making few comments recently and bring certain optimism to the market. I believe in part, or partially at least, the market was recovering because of this perception that the market is taking based on a person who was actually the ex-president of the Federal Reserve, the biggest central bank in the world. She said this morning, CPI report showed that in January, the headline consumer price index fell to 3.1%. Sorry. As you can see, she's talking about how it drops to 3.1%. So she's trying to sell actually a bad news as a good news. Inflation is dropping. This is good news, even when it's dropping less than expected, right? That's 6% points below its peak in June of 2022. Again, positive reading. Janet Yellen is trying to point that even when the inflation rate is worse than expected, it's still higher than expected. Even in that case, she's trying to say, or see the glass half full, and just say that actually is much lower than the ones we saw in June 2022, when it was the top record of the inflation coming to the West countries. Bond rates on the second 2 years bond rate drop it 8.6% to 4.56%, which is good again, because the reading that we are doing is if the yield, if the returns of the bonds are dropping, means the price of the bond is rising. Therefore, investors are actually buying the US bond in these cases, which means like, again, by this con, we interpret that if the yields are falling, it's because the interest rate gonna get cut. If the yields are rising, it's because the interest rate gonna get high. So we can read by fixed income market that actually the expectations is, again, positive in terms of new coming interest rate cuts. US stocks rose too. Nasdaq increased 1.3% yesterday. SP 500 gained 0.96%. You have seen right now that futures are quoting bullish right now, and is still rising. Euro-dollar slightly increased to 107.30. This is very interesting. Let's take a look on euro-dollar, because euro-dollar was dropping too. You can see here. Obviously was dropping because after this expectation on inflation, the dollar index was rising. Let's take a look first to euro dollar index, DXY. We mentioned this market, this index has, and the potential, the bullish potential of this index based on the pattern that I share with you on the social networks. You can go to ETFX Connect on X if you want to follow the screenshots, the charts, and the news I'm sharing with you. But even here, you can see that on Tuesday, I was sharing to you the results of the inflation rate and the movement of the price, mainly in the DXY dollar index. You can see here how the price was breaking up 104.50, which it was the target. After that, it's also true that the market was getting more calm. But right now we are quoting at 104.60. And still, I believe, probably the main target, the main goal is reach 105, 105.50, the next levels on dollar index. And if that happens, back to euro dollar again, we will see that the price on euro dollar gonna keep dropping, the pair gonna keep dropping, euro gonna still losing power against the dollar, and therefore the pair gonna start to get weaker and weaker. And I believe the final goal of this one is probably approach to the levels of 105, 1.05, because it's probably the long-term support that we can see in euro dollar that has been testing since 2015 several times. That's why I believe that's the next level we're gonna face. Coming data also, United Kingdom. We got data from United Kingdom. Here's the calendar. I'm gonna read you also in a minute the comments. But as you can see, the main thing we have seen in United Kingdom, this is the whole week. Yeah, this is the whole week. For today, which is this, we got actually, market was disappointed with the GDP of United Kingdom, the Q4 and the annual one. It was a contraction of minus 0.3% in the Q4 of the last year, and a global contraction of minus 0.2% annually. Still, some numbers was good. Not everything wasn't good, but in this condition, especially what I mentioned a few minutes ago about the dollar, the cable, which is pound dollar, GBP USD, it was dropping after what he was doing at the beginning of the week. It wasn't bad news, but the macro data was good at the beginning of the week, but it was disappointed by the last results. According to official data, the gross profit, let me set the whole screen with you because otherwise you are not going to see the whole thing. According to official data, the gross domestic product, GDP, shrank by 0.1% between July and September before contracting 0.3% in the 3 months leading up to December, which means the Q4. According to Reuters polls, all experts had predicted a 0.1 fall in the fourth quarter, but the actual contraction was more severe. Only Germany among the G7 countries is performing worse than Britain, with its economy only 1% greater than it was in late 2019 prior to the COVID epidemic. The Bank of England rate cuts has June is once again being discussed by investors after data released on Wednesday revealed that inflation held at a lower than expected 4% in January, which means what it could be bad news for pound dropping against the dollar is actually good news for London Stock Exchange, because it means that the Bank of England gonna actually decrease the pressure on the financial cost, which is the interest rates, and therefore it's gonna be available more liquidity for the market, which is what we expect. What else? By the way, just a few days ago, we were considering that the first central bank about to cut interest rate was Federal Reserve, probably followed by the European Central Bank, and the last one, it was expected to be the Bank of England. Based on this result, based on these numbers, maybe Bank of England could be the second one in that line to cut interest rates. What else we can... Oh, yeah, we also got here the investors were pricing a roughly 68% chance of a first Bank of England rate cut at its June meeting. Let's see if that expectations actually go in line with the market or not. Nevertheless, industrial production, labor activity, and the trade balance are improving, and Finance Minister Han sees things of brighter times ahead. Of course, we can see the numbers are as a productivity, production, industrial production, in manufacturing production were better than expected. It means like maybe eventually, potentially, the coming quarter is going to be positive. Japan actually was also published yesterday night the data related with GDP and inflation. We can see in the case of Japan, let me increase the screen for you. Following a revised 0.8% decline in Q3, flash data revealed that Japan's economy unexpectedly shrank by 0.1% in the Q4 last year, below estimates for a 0.2% growth. Annually, the GDP dropped by 0.4%, marking the second straight quarter of loss, below market projections of 1.4% growth and following a 3.3% decline in the previous quarter. The GDP price index, fortunately, fell more than expected, so it seems to be the economy is depressed, and the fall in inflation is one of its consequences. GDP price index was 3.8% versus an expected 4%. So again, in the case of Japan, we got bad news and good news. Bad news, the contraction of the economy. Good news, the inflation is not a problem anymore. And as I mentioned here, probably the inflation is not a problem anymore because the economy is getting contracted. And therefore, it cannot be possible get inflation if the economy is in a kind of depressive state and reducing the goods and services. So overall, I will say this is all in relation with equity and even the referral fixed income we have checked, which is the 10 years and 2 years bond of United States. As you can see, I was also mentioning in previous reports how this pattern, it was indicating that the potential rise of the yields on the bond, which, by the way, is discounted again one more time. If we see that the yields are rising, it's because we can understand the interest rates gonna get cut. That's the natural reaction of the market. I consider also important to mention that Bitcoin has been breaking up almost every single resistance for the last few weeks. Particularly, we also mentioned last week on the reports this pattern, bullish pattern, shoulder head shoulder inverted in the case of Bitcoin, with targets in around $48,000, $49,000. And I was saying last week, if we see Bitcoin go to those targets, probably it's gonna touch 50,000 as a main goal, because once you are in $49,000, the psychological barrier or price target is 50,000, which is what exactly Bitcoin did. So keep in mind that actually we are following really well the reports. And the last thing I want to mention to you today is the gold price, because gold is dropping back to the range that I was sharing with you in previous market reports. I was warning you that if the gold was losing the $2030, $2020 per ounce, probably it will be back again in track to a new range, which is the classical range between $2,000 and 1,850, 1,825 even. The bottom of all these whole range, long-term range, is $1,650. Right now, we can see that is on those levels. If you take a FIBO from the top from the bottom to the top, you can see that actually 50% of the correction of the movement, bullish movement from last bullish movement for gold, is taking us the price to $1,950 probably. Right now it's at $1,997, and again the range is from $2,000, $2,020 to levels of $1,850 per ounce. Oil, it's dropping back again, and as you can see, we can also see in long term since 2021 that actually oil is drawing a bearish pattern, and the projections are taking super low prices on oil, which only can be justified in case of a global recession. I would say we have been talking about this in previous reports, how the global demand is getting weak, or is giving us signals of weaknesses. PPI index going to be published by the end of this week. We should keep an eye on those data, because actually it's a predecessor or predictable indicator of lower inflation or deflation, which is what this indicates in the last few months. If deflation is coming and inflation is there, it means that the global economy probably is in a recession state, and in that case, oil cannot keep rising, and therefore we could see the oil dropping. But still, keep in mind, 68 to 72 is a strong support for Brent barrel on oil market. Okay, my friends, I think that's all. Remember, if you like this content, if you even want to suggest any particular topic or any particular asset you would like to discount, you would like to discuss, or you would like to actually go deeply into research, just send me an email, contact me, and I can make a video regarding this. Even if you want to share this space with any of your comments, we can even invite you to our podcast. This is my email. You also can request to be part of the newsletter for free. And that's all. I publish every single comment on ATFX Global blog on atfxconnect.com from London. Take care and good luck with the market. Bye-bye.